This week, I was pleased to have Yuri Klarman, CEO of bloXroute, on the podcast. Now, when I was in-house counsel for Wall Street firms in various automated markets, I dealt heavily with algorithmic trading and the issues associated with latency. For much of trading on Wall Street, a millisecond or even a picosecond could impact execution quality, and therefore, firms use software, hardware, architecture, and even geography to try to compress this time. It was an arms race. In digital asset markets, miners and validators produce blocks on the chain to reflect its change in state, and that production might represent a trade. In that way, the finality that they create on the chain is very similar to what an exchange does with regards to a trade. It's an analogy, but Yuri, in this episode, shows how they actually work, and from this we move from how sophisticated traders can actually extract value by trying to influence the ordering of blocks on the chain. This is known as MEV. Phil Diane popularized this term in a paper he did in 2019 and has a company called Flashbots that provides a lot of data on this. We reference it in the podcast. Lastly, we close up with a project that bloXroute is pursuing to make the settling of transaction costs on Ethereum, otherwise known as gas, more efficient. Yuri is very knowledgeable and great at explaining. So I hope you'll learn a lot from this podcast. I know I certainly did. Please give us feedback. There's plenty of ways to do it. We're on Twitter, LinkedIn. We have a website. If you like the podcast, share it in your podcast app and send it to one person you think might like it. Why not? Thanks so much. And now here's a podcast with Yuri Klarman, CEO of bloXroute. Welcome to The Encrypted Economy, a weekly podcast featuring discussions exploring the business, laws, regulation, security, and technologies relating to digital assets and data. I am Eric Hess, founder of Hess Legal Counsel. I've spent decades representing regulated exchanges, broker-dealers, investment advisors, and all manner of fintech companies for all things touching electronic trading with a focus on new and developing technologies. So this is Eric Hess with The Encrypted Economy, and today I'm super excited to have Yuri Klarman, the CEO of bloXroute, on the podcast. Yuri, welcome.
Hi, Eric. Thank you so much for having me.
So you have an interesting background. We always often start our podcast with that. Do you want to give us a little bit of the story of, what brought you to where you are today here?
Sure. So I was actually a software engineer back in Israel, I was a developer doing the regular developer stuff. And I found it kind of like not the greatest experience to be, starting work very early in the morning and working very, very late. So I decided I went to Northwestern University and I decided to do a PhD. And, I was very focused on being like, okay, I'm going to academia and professorship. So I joined there. I started my expertise is computer networks and specifically blockchain networking. And so I started my research with my then advisor, now co-founder, Professor Kuzmanovic. And we were doing all sorts of research on different aspects of networking. And we started to dive into blockchain networking. And when we did that, coming with our background as networking experts, then a few things became apparent to us, which possibly were not that apparent to other people, specifically how the network layer, how in a blockchain, how blocks and transactions propagate, and how that is the single most important bottleneck into scaling blockchains, and really the only thing that prevents us from scaling blockchains. And so we kind of we dove really deep into that rabbit hole. And then we came up with bloXroute, okay, basically like an infrastructure which allows blockchain to scale. Doesn't matter which protocol, doesn't matter like protocol agnostic, proof of work, proof of stake, whatever. And then I remember me and Alex, Professor Kuzmanovic, were sitting in his room. And we're kind of like outlining what it would look like and potentially what the business around it. And we said, well, this is like $1 billion idea, not $1 million idea, $1 billion idea. And we kind of have to do it. Like, you can't give it up. Like, this is too valuable. This is too good. This is too innovative. This is too important not to do. So we started a company, and I had zero intention of working in a startup, let alone, running a startup, starting a startup. And so we found ourselves at we know what needs doing. And so that. And so we started bloXroute and we hired other people, and Eyal, our co-founder, joined us. And that was 2016, 2017 or so. And so kind of like my background, I wasn't even like, I was very focused on going to academia, but it hit us, this great idea hit us, and we'll talk about this in a second. And then we realized we have to do it. And now I'm incapable of doing anything else. Like once you do startup once you do, I can't, like I used to be a software engineer. Like I can't even touch our product at this point. Like nobody would allow me to touch the code. Like, Uri, you'll make a mess out of it. Like nobody, like not the research. Like I do, bringing the vision and stuff around that. But at some point, once you start doing a startup, it's very, very hard to do anything else.
Exciting. So, and we're going to get into it a little bit. So, we talked prior to the podcast this notion of layer 0, and there's obviously layer 1, layer 2. On the podcast, we've never actually broken down the different layers. I think a lot of listeners may understand, but in the context of layer 0, let's sort of like sketch out the
Sure,
topology.
sure. So you're absolutely like, people throw these words around like layer 1 and layer 2, and they're not really sure what that means and like what's the stack of the blockchain. So let's break it down for a second. So when people say layer 1, they mean the consensus layer, the blockchain itself. Okay, that could be Ethereum or Bitcoin, or I don't know, Polkadot or Solana or any of or Celo, whatever. That's the blockchain itself. When people say layer 2, they're saying, can we build some system on top of it that uses the blockchain but doesn't put every single transaction there? So layer 1 transaction is, I send you Bitcoin, I create a transaction, it propagates, it gets into a block, and voila, that's in the blockchain. Layer 2 is saying something like, how about me and you create a joint account? I put 5 Bitcoins, you put 5, or 5 ETH, I put 5 ETH. And then that joint account has like, it's when it closes, it needs to bring you 5 ETH back and 5 ETH to me. And then after we do this initial step, now if I want to pay you 1 ETH, I can just sign you a message saying like, okay, now it's an update to the joint account. It should be 6 for you and 4 for me. And then you want to pay me. And so now it's like you pay me 2 ETH. So now it's 6 for me and 4. And we can update it a million times. We're not actually updating the smart contract. We keep it to ourselves. And only when we decide a day from now, a month from now, a year from now, whenever, that we want to close the account, maybe at the time, well, you got 9 ETH and I just deserve 1 because most of my payments were towards you, then all these interactions don't really happen on the chain. You just commit it every so often, let's say after a year or something like that. So that's layer 2. Layer 1 is the actual blockchain. Layer 2 is on top of it. bloXroute is layer 0. Is operating underneath the blockchain. So we operate at the network layer. What does that mean? Well, you might run a node and I run a node and a bunch of people run nodes and they send blocks and transactions to one another. We operate in propagating transactions, propagating blocks. We're a faster internet for blockchains, might be a good explanation for it. And so let's break it down even further and even more simply. The way blockchains work is that, let's say I want to send you 1 Bitcoin. I create a transaction. The transaction says, send 1 Bitcoin from my account to your account. And then I sign it. So it's a cryptographic signature, which shows that I am in charge of where the money is coming from. And then I create this transaction. And I send this transaction out there to the peer-to-peer network. Everybody hears it. And then after a while, a validator or a miner, depending on the blockchain, would hear all these, they all hear these transactions, would aggregate all these transactions that it hears into a block. It's successfully created and add that to the blockchain. So every so often, somebody would create a long list of transactions, a block of transactions. And the result is a chain of blocks, right? The blockchain, which contain all the transactions that ever happened. So what we do, and that's how blockchains work. That's kind of like the TLDR. What we do is that we allow blocks and transactions to propagate faster. So we kind of like keep everybody in saying like, here are new transactions, here are new transactions, here are new transactions. So everybody knows all the transactions waiting to be mined, waiting to be added to the blockchain. And people call this, in Ethereum, it would be the mempool. There isn't really such a thing as the mempool. There isn't a single one because at any given time, I might know a few transactions, other slightly different transactions. Like maybe I know one transaction you haven't heard about yet. And by the time we sync, you already know 3 transactions I don't know, and I know 2 other new. So there isn't a thing, the mempool. Each one has a slightly different perspective. And what bloXroute does is keeping everybody knowing the same mempool. So if everybody knows the same transactions, when you mine a block and you want to send it to your peer, you don't actually need to send the entire block, like a long list of transactions. You can just send the metadata. You can say, oh, I have this block. It has transaction 5, 37, 103, 404. And when I receive that, I know what is transaction 13, 47, 404, etc. So the block can be compressed and decompressed on the other side. You don't need to trust us. You don't need to trust anybody else. You still validate the block. When the block propagates on the wire, right, when you send these packets over, and again, I'm a networking guy, so this is my angle. When you send the block on the wire, you just send smaller pieces of data, because if everybody knows the transactions, you don't actually need to send them. These are the layers, right? You have layer 1 is the chain itself. Layer 2 are stuff on top of the chain. We operate underneath it, right? The same way that if you run a node, your node has no idea whether the data he's receiving, if that went over copper wires or optic fibers or through satellite or through a cellular connection. You have no idea. Or the node does it, like it just got the data. That's the important piece. And so because it's underneath it in the stack, and we do the same, we operate at layer 0 underneath the chain. And before hopping and comparing it to other solutions out there, why are we doing it? Why did we start bloXroute to begin with? Because it turns out that the network layer is the most critical piece when it comes to scalability. And why is that? Because if we talked about how blockchains work 3 minutes ago, right? People create transactions, they propagate, and then somebody take all the transactions and add to a block. There is a prerequisite, there is a requirement if you want to create a new block and a new valid block, and that is you must know of the previous one, right? You can't add the new block before hearing of the previous block, because maybe some transactions are no longer valid. Maybe they're already were added in the previous block. So you can't add a new block of transactions unless you know what's the current state, right? Which blocks had appeared. So you can only create a new block if you've heard the previous one. And why does that matter? Why am I making such a big deal about it? Because if you try to take a blockchain and scale it, let's say by 100x, 100x, by the way, is nothing. Like 100x brings us to nowhere close to how big we need to be. But if we scale it by 100x, so some miner or some validator create a new block, and it's 100 times bigger, right? You do 100 times more transaction per second. The block is 100 times bigger. If I created this block and I need to send it to you, my peer, I need to send 100 times more data. It takes me 100 times longer to send that data. It takes 100 longer time for everybody to hear this new block. And so the time until the next block can be added also increases by a factor of 100, right? So you can make them 100 times bigger, but then you'll have to space them out. They'll have to come at a slower rate. They'll have to come, you go 100 times bigger, but the time between blocks would increase by 100 times, right? If we can compress them and send them super fast to everybody else, then we can allow blockchains, all blockchains, proof of work, proof of stake, doesn't matter what the protocol is, it's about data propagation. If we can do that, then we can allow any blockchain to scale. And this is what got us super excited and how we went about it. And this is why we're super excited about layer 0 and kind of like the infrastructure that allows blockchains to scale.
Great. Now, I've also heard you sort of compare what you do to what Akamai did for the internet. Do you want to like draw that analogy? I think it would also help to sort of explain what bloXroute is.
Akamai is a company I really look up to. I actually am friendly with Jonathan Dealey, one of the co-founders. And Akamai really changed the game coming from MIT in like 96 or something like that of the internet. What they did is, in order for people who start surfing the web, and in order to get, like, you go to a website, there's a bunch of photos there and a bunch of articles and whatnot. Instead of you going to the server who runs that website, which might be on the other side of the world, and then get that picture and download it, it takes forever. So you go to the website and it loads slowly. They created the CDN, the Content Distribution Network. What that means is that in any major city, anywhere close to you, nowadays, literally everywhere around the world, this data is stored. So all the pictures, if you go to, I don't know, to Twitter, or Twitter is a good example. then you don't actually need to go to their servers in in California or something and bring the images there. The images sit, I'm in Chicago, they sit right here in Chicago. So when I go to the website, it redirects me to grab items from very close to me and everything open up in a snap. And that really changed the game for the internet because it changed the experience. All of a sudden, you can get everything fast. And that's what the concept of CDNs, right? Content distribution network, it just makes sure that the data is close to you. bloXroute, we created the BDN, the blockchain distribution network, which allows, it's not about static data like images, rather it allows for blocks to be propagated extremely fast to improve the experience and to be able to produce larger blocks at a higher rate. And so these are kind of like, there are a lot of similarities. We can talk about the business side as well, but that's kind of like the heart of it. Like they allowed images and items and static items to be broadcast. We allow for dynamic blocks, keep coming, etc., to be propagated extremely fast. And that's kind of like the analogy. And also, they're an awesome company.
So we'll sort of take the other side of addressing the scalability, just to kind of continue with the, I guess, the educational. See, we have a aspiring professor here, so why wouldn't I take advantage of it? So in many ways, you're doing at the back end what sharding is also trying to do on, I guess, on a layer 2, sharding or even parachains or basically anything where you're collecting these transactions and trying to compress them and then, reserving a block or locking a block and then facilitating all this scalability off chain and then putting it on chain. Is that
so let's unpack that. So first of all, I would even argue that sharding isn't a layer 2, it's a layer 1, and we'll talk about this in a second. But these are like our composable methods. It's kind of like they're not mutually exclusive. The idea like bloXroute is completely compatible with Power. I literally spoke with Polkadot guys like yesterday. This is like bloXroute is completely compatible. We allow for blocks to propagate fast. So let's talk for a second about what sharding is. Sharding is the idea that instead of having one chain, you'll have, let's say, 100 chains, but they're all mini chains, right? Each one of them does this thing like it's a chain, but they think of it like a braid. They interleave with one another. Okay, so you can transact here and transact there, and so like you have 100 chains which interleave, so each one commits to another one, and the result of that is that their security properties are kind of like joined. So think about it like, well, if one chain can do 15 transactions per second, then 100 chain can do 1500 transactions. That's very simple math. And so instead of using 100 different chains, these are connected to one another. Their finality and security and all liveliness and all these kind of like parameters are not divided among 100 chains, rather they are combined among them. And this is the basic idea of sharding. Each shard is its own chain, and they kind of like interleave with one another, so their security is joined. Parachain is a very similar concept. Also, Ethereum and the Beacon chain, very, very similar, but the idea is that they're not just interleaving with one another. There is a main chain, right? The relay chain in Polkadot or the Beacon chain in Ethereum, which all the other chains interleave to, right? So it's kind of like, think of it like 100 chain, and every so often they commit the hash of their block into the relay network or whatever the Beacon chain is. And so this, if we go back to what's the definition of layer 1 and what's a layer 2, so sharding, if you take the chain and break it into 100 chains and they interleave with one another, that's a layer 1. It's not a layer 2. It's not on top of a different chain in every so commit. If you talk about like a Beacon chain and a parachain, you could call it a layer 1, or you could say, well, listen, no, the relay chain or the Beacon chain, that's the layer 1 and the others are on top of it, so the other are layer 2. So that's like it's a game of words. I don't think it matters significantly, but that's the principle. And so bloXroute, how do we compare? Well, if you do 100 chains and you can successfully do it, and it's a lot easier said than done, well, we'll scale each one of them. And so if you can make it that you run 64 or 100 chains, then you get a 64x or 100x improvement. If we can improve that by another 100x, then you get like a 10,000x. It's great. So the idea is that we can allow, and again, I said earlier that 100x is nothing and we need that much more. 100x brings us just to be able to do like a quarter of what Visa is currently doing or whatnot. And nowadays, when you talk about DeFi, when you talk about like all the interesting stuff blockchains are used for, decentralized exchanges will eat any amount of like throughput that you'll give them. You'll need layer 2, you'll need layer 1, you'll need layer 0, you'll need like aggregate, you'll need literally the bigger you can make it, the cheaper you can make it, the more it would be used and more professional and more value would be created. So these are not competing solutions. These are composable solutions with the slight difference that bloXroute and layer 0 is very simple. Like we just like discuss it like how it works, right? We keep everybody in sync about the transaction and then you can compress it. There's no rocket science math around how you make it work and this breaking the security and merging it again. So we're just a simpler solution. So it's easier, but these are all composable and all compatible. Does that make sense?
It does. Just don't test me. So that we talked a bit about the benefits of the scalability, but what are some of the implications of the network layer that people may not be as aware of?
So coming from a networking background and working on the network layer, when we got into DeFi more deeply, then we all of a sudden realized the DeFi game is very different from what people think. Right. People think that like, well, I'm a DeFi trader. I go like I sit, I look at the prices on Uniswap or whatnot like that. And I wait until the last, like I see it like a dip and say, okay, now is the perfect time. I identify that this is the time. I click buy or sell or whatever, the dip or the peak, whatever, or liquidity, like liquidations, doesn't really matter. And they think this is all like immediate, right? Like you would if you go to Coinbase or something like that. Like you send an order, it just happened, etc. But even at Coinbase, let alone in DeFi, the game being played is actually very different than how you imagine it. So let's say that you're sitting at home, you're a home trader trading in DeFi, let's say Uniswap. The prices that you see are not the real prices. It's very similar to playing a game with a very high lag. A block was mined, added transaction, somebody sold, let's say, ETH for BTC or that, prices changed. By the time you see it, you probably see it like a second later, 2 seconds later, or something like that. That means that in 15% of the cases, a new block was mined, the prices are already different, and you don't even know it, right? You're seeing the prices as they used to be when the block was created, right? So for those who are less familiar how Uniswap works, people buy and sell like any other trade. And the idea is that like, well, if I sell ETH for BTC, then the price of BTC would increase, the price of ETH would go down, and there might be arbitrage opportunities and kind of like every trade changes the ratio between prices. But put on your high frequency trader hat for a second and think about it this way. If you're seeing a block, it takes you, in the best case scenario, 800 milliseconds. That's like 0.8 seconds, okay, under a second. In the best case scenario, it takes you 0.8 seconds to get a block. So you see the prices and then you click, oh, buy, I want to buy ETH. You send the transaction. That transaction is going to take something similar, like over half a second just to reach the pools and the miners, which they need to get the transaction, they need to try to put it in the block, and then one of them would create a new block. So during this time, until you hear of the block, and by the time you send the transaction, a new block might be mined. Like a new block come in Ethereum every 13 seconds on average, but that's the average, right? 8% are mined within a second. 16% or so are mined within 2 seconds, and so on. And so if it might take you 6 seconds until you see like if you're using like something like Alchemy, like I think Infura was like after a second and a half, Alchemy were like after 6 seconds. These are not companies that are optimized for speed. These are companies which optimize for supporting a lot of users, but they're not there to make it as fast as possible. So you might be seeing prices which are 6 seconds ago. Okay, 6 seconds ago is for average, 50% of the case. A new block was mined. Prices are different. You just don't know it. And so I really think about it like playing like Temple Run or something like that. You're trying to run, you're trying to cap gold or something like that, but you're not really playing that. It's more like you get like a friend texts you, well, you should jump right? So a block was mined, but it takes you a while until you hear about it. And then like you yell to your brother upstairs, oh, jump right? Because that's like your transaction until it actually executes. your chances of, actually hitting the goal are not that great because you're hearing about it slowly, you're reacting slowly. So these are things that most people in DeFi are completely unaware of, unless you're working at the network layer. Like we actually, with the DeFi boom of June of 2020 last year, we found ourselves in this like super cool position where we can give access to blocks very quickly, like not at the speed of light, but pretty close to the speed of light, right? We propagate blocks and transactions. I don't know, 150 milliseconds is our average, something like that. So we're connected to most top 20 pools in Ethereum. And so, side note, like we work for all chains, but we focus strongly on Ethereum because that's where all the economic activity is happening. And all of a sudden, we found ourselves in this like super unique position. Think like, I don't know, Flash Boys for DeFi is how I like to call it, right? Like Flash Boys are the people who connected New York and Chicago. And if by being 3 milliseconds faster than everybody else, if prices crash in New York, they're the first one to sell in Chicago and beat everybody else to it. And so we do that the same. We give faster connectivity, but in DeFi, where you need to be connected to everyone, because a transaction can come from everywhere, a block could come from everywhere. And so by operating at the network layer, we saw, back to your question, like the game is very different than what you think. And if you're like all the major trading firms, like, or most of them are using our services, those who don't should be using our services. And so because if you're moving $1 billion a day or $10 billion a day, you should care. So that's kind of like one aspect, like just a speed. Another aspect, does that make sense?
It does. Does that feed into the ability for people who are like validators on the pool to extract value, or you getting
it's exact. So a lot of people talk nowadays about MEV, miner extractable value,
or maximum these days.
So true, but that just to make it sound better, it really is about like the concept is of why is it like it's miner or validator, whoever construct the block. Basically, the idea is that like, oh, if I see like I could be an arbitrage trader or whatnot like that, but who would be the best one at it? The miner or whoever creates the block he can put the sell orders to price down as much as possible and then make a giant trade against them, or the opposite, all the buy orders. If there's a liquidation opportunity, he can drive the price down, intentionally create a liquidity, right? Think about a liquidation. If you have a loan or something like that which is close to being like liquidated, he just might be able to push it enough in order to liquidate it and then return it back to normal. So whoever creates the blocks are actually in the best position to extract that value. Now, miners and pools, actually, that's not their expertise. So what we're seeing nowadays a lot, especially with flashbots, is that they're called searchers. People would look for these opportunities. Let's say I can capture 10 ETH from all these kind of things. Like 10 ETH is a lot. Usually it would be like half an ETH or 1 ETH or something like that. And then I create that, like, oh, this transaction, then that transaction. We'll talk about front running, back running, sandwiching, like what are these opportunities exactly? But I can do that. And then I put a really high fee on that. I give it to the pool and say, include these transactions in these order, and I would pay you 0.9 ETH, right? So it's kind of like there's 1 ETH to be extracted. The searcher might keep 1% or 5% or 10% or something like a small percentile, and most of it would give to the miner. Why would it give the most to the miner? Because somebody else, like there's going to be a bidding war. If I'm just offering him like half an ETH, then somebody else who see exactly the same opportunity will offer him the same thing, but will bribe more. So this is kind of like how the game is being played currently. And this is why it's really miner extractable value. It's kind of like, it might be done by somebody else, but at the end of the day, the person or the entity extracting the most value is whoever construct the block. So that's
now I suppose not all miners would take that, right? I mean, if I'm giving you an order in the exact order I want it to be in, and I say it's not so much the order, I guess it's also the precedence, right? Like, hey, I want to be the first in line in this precedence, and I'm going to pay you more so I can be first in line.
Right. So it's actually both. Like I want to be first, and I want this to happen, like this transaction, then that transaction, then my transaction, then somebody else's transaction, et cetera, et cetera. And nowadays it's very common in Ethereum. Like most pools participate in this. Like we can talk about further in Flashbot about this like deeper, but let's break down. So this is MEV at the high level, and we can break it down into what people are saying, what is front running, what is back running, what is sandwiching, which is doing both, and what is like liquidations and toxic liquidations. And so we can kind of like, I think it's worth maybe touching on this. So if we said just a second ago, like I want, let's say this, somebody is selling 1,000 ETH for USDC on Uniswap. There is a transaction, it sells tons of ETH, the price of ETH would go down. Front running is saying, oh, I want my transaction to happen before that. I want to sell my ETH before the price crashes. Now, front running is not only capturing value, I do this before this thing happened, it's also screwing over the transaction. Whoever you're front running, he's your victim, because if I sell ETH before that, then I push down the price of ETH, and whoever sent that transaction will get less money. He'll be selling ETH at a lower price. So front running is just, I want my transaction to happen before this happens. Back running is a similar concept, but if that person sold ETH, 1,000 ETH on Uniswap, it drove the price down. And now if you look on all the market arbitrage between like centralized exchanges, decentralized exchanges, etc., the real price is somewhere in between, right? If once all the arbitrage is kind of like cleaned and done, then the Uniswap price was pushed downward too much compared to everybody else, and the truth is in between. So back running is, oh, I see that the price of ETH went down. It went down more than the actual price, or what I perceive to be the actual price. So I want to buy ETH immediately after that transaction. So back running is the same thing. I want to buy after it happens because I know the price would continue up until this like middle ground. And back running doesn't screw over the transaction. Like that, there is value to capture there, but nobody, like otherwise it would go to the random person who tried to buy after that. But it doesn't hurt the people who created the transaction. So these are front running and back running. And if you do both, it's called sandwiching. That transaction, I want to buy before it, and I want to sell afterward, and I want to capture all the value around it. So these are when people kind of like hear these terms like front running, back running, and sandwiching. They're not, again, it's not rocket science. These are, I think, very simple at the end of the day. And I think one more term I think worth exploring here is like liquidations and toxic liquidations, which is basically if I take a loan, like I put ETH and take USDC for that or something like that, I need to have a collateral, right? I put I borrow 10 ETH and I put quite a lot of USDC instead of it. But if the price of ETH crashes, then maybe my collateral is not enough or close to not being enough. And there's a process called liquidation, is that somebody spots that and say, okay, let's close this thing. So because it's not, like the loan is unsafe at this point, let's close it so we're not losing out even further. So it's kind of like cutting our losses, right? So it's kind of like, okay, liquidate the entire thing. The collateral is not enough. And whoever originates that and track that is being rewarded with the bonus, right? It's kind of like, okay, he gets a piece of the pie because he found out there's a loan, the collateral is not enough, and it's bad for the system. So people are incentivized to notice this and act on it by being rewarded for finding it. So this is what liquidation is. But if you're the miner and you see, oh, here I have like buy and sell, buy and sell, buy and sell, they kind of like balance one another. But what if I just put like sell, 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 like all the sell orders after one another, push the price really down so I can make sure that liquidation happens. It wouldn't have happened by itself. But if I play the right way, I can make it happen, liquidate it, capture the reward, and then put the buy, and everything go back to normal. And the poor guy who wasn't collateral, then I've like got screwed. And the miner or the searcher, whoever initiated that, capture the liquidity. So that's kind of like a toxic liquidation. Does that make sense?
It does. It's similar concepts to like that what's regulated in broker dealers of trading,
Definitely,
right?
definitely.
The distinction is that you almost have to think of the miners or the validators as being almost the exchange where, or the settlement where it's trading, like because today the exchanges can't do that. There's no they're heavily regulated, at least in the U.S., and there's no way that you could do that. But then you go down to the brokerage level. Their order books are larger. They may be even running their own trading systems, and there's games that are played even there, which is why IEX has the magic spool box, right?
Right. And this goes exactly to, you mentioned earlier about like co-hosting, like, or co-location.
Colo, yep.
This is basically the idea. Like, if you sit right next, so if you're the miner or if you're a searcher, like if you hear about all these things, what buy orders are, which sell order, like what's happening. Co-location is when you think about a centralized exchange, like you want to sit literally in their offices, connected to their computer directly, and you build your infrastructure to serve like nanoseconds, like the faster you can make it, the idea you need to be faster than everybody else. And so like if you hear about it fast, you can front run, back run, you can do all these things.
That's actually that's a great point. That's a great point, because I was saying, it can't occur at the exchange level per se, but you're spot on, because you have these colo centers, NYSE,
right. You get an advantage.
You have an advantage. You have a speed advantage. You pay more, but you get this great advantage. The difference is the exchange can't do it, like in the way that the miner,
Right.
the validator does it. But in fact, they're actually are doing it because they're facilitating it, right?
Yeah, it's kind of like I hire somebody to do it. That I hire means like, okay, somebody else is doing it. He's sitting at my office, like connected to my building with it. So, and I charge them for it. So I'm not doing it. I just capture the value. Similar to miners and validators, that they're just accepting bundles of transaction, but they capture the value, which is again why the miner, like MEV, is the miner extractable value, not really the maximum. It's not what the total value, rather what can whoever construct the block and order the transactions, what can he achieve by adding transaction, removing transaction, reordering them, et cetera, et cetera. So this is exactly that.
And there's a funny story I'll just throw in while we're on the exchanges. So before they actually did all the colo facilities, before they got into that game, there were actually shops that would like buy retail space that was located across on the NYSE data center. I think it was like a restaurant or something, where they basically, some trading firm went in and just gutted it and just like, built all the telco lines so they could get that like immediate access, that the hop would be that much quicker. So yeah.
I think it was called like the Red Building. I don't remember.
Yeah, something like that. Yeah.
There's like the Red Building in front of I think it was in front of the New York Exchange, if I remember the story correctly. It's kind of like everybody bought this, kind of like, because they're literally like the closest hop you could get without like being within the building. And nowadays you're just literally within the building.
But it was the early stages of the Red Building was even that they went in, they gutted an existing, I think it was a restaurant or something.
Really?
They basically, yeah. So there's some lore behind that. Yeah.
Yeah. Well, you have background with IEX, right? So you're kind of like, you know exactly.
Yeah, so for the listeners, I was IEX was a client of mine, and so I actually right around the time that Michael Lewis was writing his book. So who knows? Maybe I could have been in Flash Boys, but I chose not to go that route.
Like IEX is Flash Boys, the people who connected New York and Chicago to get that slight advantage and beat everybody else in trading. And
IEX wasn't the one who got the advantage. IEX was the one who put in the magic shoebox, to equalize it. So yeah,
exactly. So going back to your original question, if you're coming from the network layer, then all of a sudden you understand these games are speed games, or like everybody can participate, but you have a very big advantage if you hear all the transaction as they come faster, if you propagate your transaction faster. And you can't co-locate like you could with an exchange, with a centralized exchange, because you need to be connected with everyone, right? You need to be connected with all the pools and all the miners and all the nodes who create the transactions to see as they happen. And so our infrastructure, which is built to connect everybody, kind of like, okay, we level the playing. Anybody can get connected and be co-load, right? Be co-located with everybody else's. It's more important for the larger traders just because they move bigger sums of money. But like, it's just as important for your personal trade. You're just like, is it worth it for me to pay for it? not the same way that it's worth for somebody who moves like $1 billion each day.
And so, and one question I have is like, when I hear MEV, my first instinct is to think this is bad, right? Because it's an unfair advantage. But I've also heard that there's a lot of arguments that it's not all bad, that there are some positive aspects for the community associated with MEV.
So definitely, people say there are good MEV and bad MEV. I'm not sure it's right to say there's a good MEV, but like some MEV is what you want to happen, which is like you want arbitrage to happen. Arbitrage sound bad, but basically if the prices are skewed, right? Like one BTC is worth 10 ETH or something like that, and the price of ETH is so and so in US dollars, let's say 2000. And so there should be a ratio, like the BTC price in US dollars must meet that. Like you can't have like prices being wrong because there's an opportunity, right? If it's kind of like, well, listen, the ratio of BTC and ETH is wrong. I see their prices. It's not really 1 to 10, it's 1 to 11. I'll buy it until it reaches 1 to 10. And this is the good MEV. This is kind of like for decentralized exchanges to work, for borrowing and lending, for all these kind of things. You actually do want this to happen. You want arbitrage to happen and kind of like make sure all the prices eventually kind of like equal to where they should be. The bad MEV is when people get screwed. The bad MEV is I made a trade, and instead of that trading going through, somebody front run me and captured my value, and I got less value because he saw that, and back run, so he sandwiched me, et cetera, et cetera, et cetera. So that's the bad MEV that people try to minimize and democratize and do to reduce it. So MEV in general, like some of it is needed. In most of it, what people talk about is actually a bad thing. But to be completely fair, if you look, it's not good for your trades, but it also wasn't that great for you when using Ethereum cost like $50 or $100 to make a transaction. And the reason that fees were so high, so that takes us to, I think, like to the next point, maybe. Fees were super high. What are the fees? Like, how are they determined or something like that? Well, you have like the block space, how big blocks are, the gas limit of Ethereum. So in Bitcoin, the block size is determined by bytes, how many bytes can be in a block. In Ethereum, Ethereum is a series of instructions, right? Like store this value, read that value, add this number to that number, and like buy here, sell there. And each operation costs what is called gas. And so it's the same measurement, but it measures it like what's the gas, how many gas can be in each block. And so fees are determined by how much the gas limit exists, because everybody want to participate, right? Everybody want to send their transaction, but only the most valuable one will be there. So people, like if you are just willing to pay 0.01 cent for your transaction, and I'm willing to pay 3 cents for my transaction, then my transaction will get, like as a fee, my transaction will get in with similar higher value, higher paying transactions, and your transactions will be pushed out. So the chain is being used for the most valuable transactions. And that makes sense, as it should be, right? So think of it as like as a demand and supply, right? The supply is the gas limit, how much room is in there. And the demand is like people want to make transactions, but they're not necessarily willing to pay that much on it. So the most valuable ones will get in. That would be the fee based on like the lower one among them. And everybody else would be priced out, which sounds bad, but it isn't necessarily bad. But that's in theory. In reality, something very, very different happened. What happened was not people bidding fees in order to be in the next block. They tried to put fees in order to be the first in the next block. So it's not about being in the next block, it's about the order in that block. So prior to Flashbots and MEV and the current structure, everybody just like outbid one another, which drove the fees through the roof. Like even with the gas limit increasing from 8 million to 10 million to 12.5 million to 15 million. So we can talk about this and the Eagle project and all that in a second. But basically, as somebody who has a lot of, like, I'm very well aware of the networking issues, the gas limit, and what can be done, and which transaction, how many transactions can get there. Even though the supply, the room for fees grew drastically, fees actually went up because people were outbidding one another, not to be in the next block, but where in the next block. And that drove everybody's fees through the roof. now with the current state of MEV and Flashbot, so people try to create these bundles and try, well, I capture 1 ETH, I'll try to pay 0.9 of that to the miner, etc. This all happens outside of the regular fee payments happening. So regular fees went down by 10x or more than that. So with everything bad regarding MEV and about like, and it should be mitigated and it should be minimized and it should try to be democratized and to the best of our efforts. But let's not take it away. And I was very skeptical and concerned regarding MEV and Flashbots when they came out. But let's not take the credit from them about being able to drastically reduce the fees for all the users of Ethereum, which is fantastic and great. And so now we went from this hyper high fees weird situation into what we expected, the demand and the supply, and kind of like, okay, how that is being set and how the fees are being, like, depending on willingness of people to pay fees to be in the next block and not where in the next block. So that's kind of like Flash Boys and Flashbots and MEV, I think, and kind of like all that. Does that make sense?
Right, and that seems more equitable, because if that speed isn't important, and and you're trading into a market where you don't think there's going to be that kind of variation that makes your execution be negatively impacted by that, then why not? In the U.S., there was a lot of discussion about, even when you have these large firms providing all this liquidity and having that speed advantage, they also provided that incentivized them to provide a more liquid market. And they were liquidity providers. So they normalized the market, even though you could argue, well, due to speed. And certainly there's a spectrum, right? It's, there's abuses, but there's just also normal market economics. So before we actually move to some of the work you're doing on managing gas limits and block size, I'm just going to like double click a little bit more on this notion of MEV and how it relates specifically to what bloXroute is doing. How does the networking component, if you're all working off of the same mempool, then arguably, I guess it reduces the arbitrage across different pools, and thus it facilitates sort of a more orderly way of managing these blocks. At least everybody can see what everybody else is doing, and it's not just attributed to some sort of noise that occurs between different mempools. I mean, I'm summarizing it, and I'm sure you have a better answer than I do, Professor. So I'll turn
first
to
of all,
you.
First of all, I'm not I got a PhD.
I know. I know. I'm playing into it. He's like nervous. He's like, I came onto your podcast as a CEO. I'm not going to let people come out of here thinking that I'm a professor. I point noted. He is not a professor. He had aspirations.
Do not believe a word he's saying.
Do not believe a word I say. That's number one for this podcast.
So I think what MEV and Flashbot does is kind of like siloing all these games happening from normal usage, which is a good thing. Okay, so it's kind of dividing between, and what I said about the fees and whatnot, etc. Like, you want to send your friend some ETH, you don't super care where it is. Like it's not buying, it's not selling. Like, you shouldn't be paying super high fees for doing something like that. And for that use cases and a bunch of others, it's really, really helpful. Like, so like, you're just like, let whoever play the MEV game among themselves. So MEV kind of like silos all these games. Now, within that, again, but going back into what we're doing, if you hear about transactions propagating faster, then you have an advantage. You want to hear about all the opportunity. Am I being front run? Should I front somebody else? Like, all the things around that. So that's one thing. That is it an advantage? Well, it starts as an advantage, but once everybody has it, it's just like, no trading firm will use like a dial-up like modem from like 97 or something like that in order to send their trades, because it would be stupid, right? Everybody are using like 1 terabit per second, like wire in a very well connected office space or whatnot like that. And it's not like an advantage. It's just like not doing it would be madness. And so we are kind of like around that position. Hearing about blocks later, when you have the opportunity to hear about them faster, just like seems dumb. But so with that, we're just allowing for the actors to be like, this is the professional grade thing to do. But in addition to that, a lot of it, like some people are really not high frequency traders. They're all they want is not to try and make like front run somebody else. But some firms are doing like 2 trades a day, but when they do, then move millions of dollars. And so they want to have front running protection. Okay, they want to be not to be front run by others. So we included this concept of private transactions or front running protection, where give me a transaction, I don't broadcast it to everybody else to be front run. I'll just give it directly to the pools. They won't broadcast it. They'll just try to mine it. If you pay them enough fee, they'll mine it. If you don't pay them enough fee, they won't mine it. But it prevents you from being front run and being attacked by the ecosystem. It's not just providing like offensive weapons here, it's providing the armor as well. You don't want to be front run. Well, if you're big, if it's a small, like, the daily trader, like, you don't move enough money to be very, very important and worth front running. But if you're moving millions of dollars, you don't want to be front run. And so the current setup, the peer-to-peer network, is inefficient. It propagates stuff slowly, and it's visible for others who might not. Dan Robinson called it the dark forest over the sci-fi novel. There are monsters in the dark forest, and you need to be very, very quiet because they'll eat you. Don't make a sound, really. So it's very similar like that. You make a transaction, it has value, boom. You're like, if you saw an opportunity, they'll see your opportunity and just reach that faster than you. And so basically the idea is not to broadcast through that, but having other ways to kind of divide the network rather than have everything visible for everyone. And in some cases, it's valuable. And so does that answer your question about
it
the
does.
network layer and the MEV side?
I see how bloXroute can sort of level the playing field for the people on the network, and also provide some defensive capabilities. And I guess
and maybe it's worth mentioning, these defenses are not just for high, big trading firms or something like that. The idea, we're not a very consumer-facing company. That's not our expertise. Our expertise is infrastructure. But we partner with wallets, and we partner with decentralized exchanges and with projects. So when they create a transaction, that is being broadcast through us. So we're partnering with them. We're providing it so it is available for the small day trader or something like that. And anybody could benefit from hiding from the monsters of the dark forest. It would just be probably through whether your decentralized exchange or your wallet, rather than through us. It would be through us, but we won't talk with you directly because we're not a consumer facing company. We don't have a sleek UI and whatnot, and a giant sales team trying, and giant ads trying to get all the people out there to use us. Rather, we work with the infrastructure and the aggregators to provide this to the best user experience.
And then on the security layer, or the ability to see the mempool yourself, I know you've spoken about that as well. You want to touch on that?
Sure. So I don't want people to get the impression, well, listen, bloXroute can now censor everybody and only they get it. No, we're about speed. Everybody will see these transactions. Everybody will see these blocks. We can't prevent them from propagating. What we give is a speed advantage. Okay, you'll hear about that block from somebody else, but we'll tell you about it faster. You don't need to trust us. Validate it yourself. The way it works is if you're running a node, your node is connected to a bunch of random peers around the world. We're just another peer. Connect to us. Your node doesn't know, it won't trust us. It will receive blocks from us. We'll validate in the same way. Only we would be much faster than everybody else. And if you're not running a node, if you're just running a trading operation, you're already using Infura or Alchemy or Chainstack. We've been partnering with Chainstack for a really long time, so their speed is actually good. So you're using one of them, we'll give you an API. We'll stream your blocks, we'll stream your transactions, and it will just give you a speed advantage. We don't really affect the security, right? We don't have the ability to censor. We won't give you things which are invalid. We can't prevent stuff from it. But if you're trying to have an edge in trading here, then speed is what matters. You want to be as well connected to everybody as possible. And we spent a few years, 4 years now almost, building such an infrastructure for people to use.
Great. So now to kind of circle back to your project on gas limits, which you started to touch on before I derailed you and brought you back.
So as somebody who's working on the network layer and who scalability matters really, really strongly, then I am deeper in the world of gas limit than most. And we found that the current reality isn't great. The way it works is that miners and mining pools, specifically those who kind of organize the miners, when they mine a block, every time they mine a block, they can either increase or decrease the gas limit from the previous one by 0.1%. So the result is that each mining pool, or the process is that each mining pool said, oh, I think it should be 15 million gas. And this one says, oh, I think it should be 12 million gas. And this one sets like, oh, I think it should be 10. And each one, when it's mining a new block, try to push it in the direction it thinks. If it's too big, it will push it downward. If it's too low, it will push it upward. And the result is that majority of the hash power in Ethereum kind of like drives the gas limit towards like it. So it's jittery, but it hovers around what the miners think. And that's how it works in Ethereum, or at least in theory. What happens in reality is that 40% of the hash powers, all the small miners, don't even participate in this game. Why? I like to say it's kind of like the American voter. It's kind of like, well, my vote doesn't matter. Like, who cares what I vote? Like, there are so many people out there. I'm too insubstantial to affect it in any way. So to our surprise, we found some of them didn't even know that they affect the gas limit. It's not a problem. They just follow what the top three mining pools are doing. So Ethermine, Spark Pool, F2 Pool, and to some extent, like pool 4 and 5 kind of like affect that as well. But basically, they decide, like you have literally 3 people deciding what the gas limit, and that is a gas limit for the entire ecosystem. And even worse than that, they actually have a veto power. Okay, like if you have these actors, and then it's enough for one of them to say, I'm not changing, I'm keeping it at this level. And if the other 2 try to push it in the direction that they think, it would stay where they are, because the other 2 are like 40% or 40% of that. They're not big enough in order to push and that. And so because 40% don't even participate, they're just voting for, yeah, whatever we're doing right now, then the 3 top pools actually decide on the gas limit. And it's not a pretty sight. That is not what decentralization look like. But more than that, it's not just that it's centralized or too centralized, because centralization and decentralization is a spectrum. They're not necessarily incentivized to push it in the right direction. Like if they say, oh, we think it's safe, we think it's good, we could totally increase the gas limit, and we actually believe the gas limit should be higher, that would actually drive fees down, at least in the short term. They might go up like maybe a year from now, we'll be at the same spot, they'll actually make more money. But immediately, they're probably looking at a downward like turn off the fees, because people would be able, like again, supply and demand, you increase the supply, prices drop. And so they're not incentivized actually to increase it to the highest level, which is safe. So that's point number 2. And point number 3, even forgetting about centralization, even forgetting about misalignment of incentives, let's say they want to do what the community wants. Who the hell knows what the community wants? Like different core devs have different opinions, not even to talk about different users who have very different opinions. And you have these pools which we talk with, and they say, like, I don't know, we look on Twitter and we see what people argue. So people are shouting on Twitter, but you can't really know what's the actual, like the fact somebody is super loud on Twitter doesn't make him really the majority. Like I know what the Geth team thinks about the gas limit. Like what does the TurboGeth, like Aragon, what do they think? That's a different client. What does Nethermind think about it? Like there are a lot of like actors, nobody knows. So there is really a lack of transparency for the miner who decide this. They have no idea what the community actually wants. And it actually gets worse when you move to ETH 2.0. Like think about, you run a validator. It's even further decentralized. What, Eric, you run an ETH2 validator. You now set the gas limit. What do you set it to? You have no idea, like, at least the big mining pools, they can pick up the phone and talk with Vitaly. Like, well, they at least can ask him. They can actually have access to at least the more prominent. It's not a great situation, but it's something. The more decentralized is, like the smaller pools don't have that access, et cetera, et cetera. And so this is the current situation, which kind of like makes it that the gas limit arguments resurface every 6 months. Every 6 months, usability increases, and then people say, oh, we should increase it. And some people say, oh, we should increase it. And people argue and argue, but it's all pointless because they're not the one deciding. It's the pools who decide, and the pools aren't really sure what they should be doing and what the community wants. Does that make sense? As kind of like what's a problem that we're trying to solve?
Yes.
And maybe one more point on this. Why is that important? Because every 2 million of gas limit, so right now it's like it was last year, it was like a 10. If you increase it to 12 million gas, that means revenues of something like $100 million per year of value for users. Okay, so if you think in 2020, Uniswap LPs earned $175 million. Okay, that's like in fees for providing this. If gas limit, and now we're at 15 million gas, so we already increased that. If If the gas limit had been increased earlier, they'll make another at least 40 million dollar less. They could have made 35, $40 million last year that they didn't, right? We increased it afterwards. If we think it's safe for the gas limit to be at 15 million, maybe we should have done it. So the LPs lost $40 million in revenues. The traders who use Uniswap arguably capture the same amount of value as the LPs, maybe more, but we'll be conservative. So let's say traders lost $40 million off trades or of value capturing there. So it's $80 million that the Uniswap users lost on the current gas limit. The rest of DeFi is probably, so like Uniswap is almost like half of DeFi or something like that. So we're talking like $160 million per year that they lost. And I'm not even talking about fees that potentially talk about another $100-200 million of saving. I'm talking about the usage, the value that is not lost there. So the gas limit is actually very, very important. It defines how many trades can happen on Uniswap and how many borrowing and how many lending could happen like on Maker and all these kind of, it really defines how much usage can work. And it's tons of money for the user. So it really should be, it's not something, well, keep it at 10, it doesn't that matter. It matters a lot. And so we came up with the Ethereum Gas Limit Project, or Eagle, which we kind of like the name. And the Eagle project, like EGL, Eagle. The Eagle project is a project that aims to solve this. And the way we created it is, we created a token. It's simple, it has 3 components. We create a token. Anybody with ETH can stake it and get free Eagles. So this is how people get Eagles. Or you could, I don't know, buy them or whatever. People with Eagles can vote on their desired gas limit. So I can vote, I want it to be 17, and somebody else could vote it, like put it at 13. And it's a collaborative tool. Everybody can kind of like work together. And every week there is a tally of votes. So like it's gonna go, we want a gas limit. If we look at everybody and do a POS, right, proof of stake, and I think, well, I have a lot of Eagles, so my vote carries more. You have less Eagles, so maybe it carries less. But if you lock it for a longer period of time, so if you're a long-term actor, then your vote carries more weight. But every week there is like, oh, a desired gas limit. There's a tally of vote, and this is what the community wants. Now, this doesn't forces the pools and the miners to do anything. Like it just tells them, this is what we want. But pools and miners, when they mine a new block, they can sweep free Eagles. When you mine a block, you can get free Eagles. And how many free Eagles you get depend on how closely you follow the desired gas limit, like what the community wanted. If you're a million off or something, you're not getting any Eagles. If you're very close, you'll get quite a lot of Eagles. And so these are kind of like the pieces around it. And maybe the last piece, which is worth mentioning, we're actually giving quite a lot of Eagles to core devs of Ethereum, because for them to vote, because it's important, but more important for them to signal. So core devs we want them to signal to the community, oh, Vitalik think this, Peter from Geth think that, okay, he think it should be 10. And Alexei from Aragon thinks it should be 20. And I don't know. So each one can vote. And now you, Eric, if you run a validator or if you have Eagles and you kind of, well, I don't know what is the answer, but here are the other answers of important people and what they're thinking. So it gives insight. You have like 100 different core devs. They have different perspective and thoughts. And Eagle allows you to see what they're doing. And then maybe you have your own intent. Maybe you're not Eric has. Maybe you're A16Z. Okay, maybe you're A16Z and you're betting billions of dollars on Ethereum success and tokens on top of it, and you really want ETH to succeed. So you see what others are thinking, you hire your own experts, you study it very deeply, and you come to a conclusion. I think the current, like the gas limit should be, I don't know, maybe it should be 15, maybe 15 is fine. But we should really aim to be at the highest level, which is safe. And that's kind of like the Eagle idea, and we're super excited about it.
So let me take a different take on it, just to put you on the spot. So do you think this could be used as a tool to sort of coordinate a price pressure up, a gas pressure up?
A price, you mean price off, like
the gas fees? Yeah, to increase fees.
So short answer is no. There are two, and again, I gave like the high level overview. First, you can't really, it doesn't change the gas limit significantly. Oh, like we changed it from 12.5 to 15 million on a day. So like it doesn't change by 2.5 million. It can only change by up to 1 million gas per week. So it's a slow moving system intentionally. But more important than that, that we get usually a slightly different question, like a similar question. Can it be misused? Can scammers or hustlers or whatever try to use it to push it, and kind of like they have a strong incentive and kind of like make some value out of that? And the answer is that the system rewards long-term participation much more strongly than short-term participation. So if you buy 10,000 Eagles and you vote with them, and you're trying to make something and you lock them up for a week, if I lock mine for 8 weeks, my vote counts 8 times more than you. So as a starting point, those who are long-term, and that means you'll have to hold this for 8 weeks. So if you misbehave in a way, then and you're saying like you can't make a quick like arbitrage on that because you're being locked for a serious period of time. So first of all, we reward long-term participation by carrying higher weight. The second is that the traders and the arbitrage and all those trying to make, they have value and they have money, like they're not small, but they're unsubstantial compared to, let's say, all the Uniswap holders, okay? Or, Coinbase are a $50 billion company. Binance, probably something similar, and et cetera. Okay? These are companies that has a lot of interest in the success of Ethereum, right? They're better, like they want to see Ethereum succeeding because their entire business is about crypto, ETH and others, and they want whatever is good for that. Same goes for, Consensus and Polychain and Pantera and A16Z and whoever. So the money, and I'm not even talking about all the ETH holders out there. And so the money held in both decentralized, like LP holders, like Uniswap users, Uniswap LPs, etc., and centralized, like VCs and Coinbase and Binance and like large actors, etc. The bags, the money, the leverage that these people have is so much bigger. Let's say it differently, their stake is so much bigger, and they can definitely lock it up for 8 weeks. Like it's insubstantial for them. So all these games that you're like, oh, can't people play with it this way and that way? Like those who can play these games are a much, much smaller group. They don't carry the same resources. They're much more like short-term actors. So the fact, like thinking of locking up your wealth for 8 weeks is inconceivable for somebody trying to get like quick arb opportunities and in these kind of operations. And so this is that's the long answer to the short answer. No, it's not a real concern. Like so, we should be aware of it, etc. But like all the incentives and mechanisms are built against it.
So Yuri, this has been great. I really appreciate it. I'm up against my next meeting, but it's been fantastic having you on the show. Thanks so much for joining.
Eric, thank you so much for having me. This was great fun. I hope listeners found it interesting and fun too.